There's been some big policy changes made by the banks here in Australia, and this means better financing for you as an owner occupier and an investor. I myself am going to be taking up some of these benefits that are happening from Australia's biggest banks. Now, if you stick around to the end of today's video, I'll break down how Emily and I manage both our home loan and our investment debt to try and create the most efficient outcome. So let's break down what the big banks are doing and how they're going against APRA regulations to allow better funding for Australians. Now, the banks have been making killer profits the last 12 to 24 months. And part of what the banks have to do is apply thresholds when you're looking for a loan. Now, the typical threshold here in Australia has been a 3% buffer. So what this means is if you were looking to get a $500,000 loan with a 6% interest rate, the bank would be assessing you on principal and interest repayments on 6 plus 3%, so a 9% interest rate with P&I repayments on that $500,000 loan. Now, what are the big changes that have come through? Well, CBA, which is Australia's biggest home loan lender, are reducing the threshold for dollar refinances. So what does this mean for you? If you're looking to switch banks to CBA, for example, instead of being assessed on 6 plus 3% threshold, the banks are only going to apply a 1% threshold. So you'll be assessed on a 7% interest rate rather than a 9% interest rate if you're looking to do a dollar refinance. Now, I myself am taking advantage of this. I'm looking to move one of my loans for our unit block in Coffs Harbour, which we purchased the unit block for around $1.4 million with, say, roughly $1 million worth of debt. So we're looking to move that $1 million worth of debt to Commonwealth Bank of Australia and get roughly a 2% better interest rate. This will save us roughly around $20,000 a year in interest rate repayments. So this could be massive for a lot of Australians. People who are in mortgage prison, who are struggling and can't get refinancing or serviceability through the banks, can now potentially get a better deal and do a dollar refinance. The reason the banks have taken this sensible approach is that if you've already got the loan in place and you're paying a higher interest rate, if you're looking to refinance, you're typically going to be getting a better rate. So a lot of Aussies might be on, say, a 6.5% interest rate, and they might be able to get a 5.5% or 6% rate. So with that improvement, it makes sense for the banks to reduce the threshold from 3% to 1% to get themselves more loans, because that's what the bank's in the business of doing. Writing more loans, creating more loans, and seeing if they can grab refinances from other banks and bring them onto their bank's books. At the end of the day, the bank works for its shareholders. It's looking to make more money. So if it can grow a larger bank book and get more clients, that means the bank is going to make more money at the end of the day. It's also better for the consumer. It's better for the everyday Australian. If the bank's not assessing you at a 9% interest rate and is only assessing you at a 7%, and your interest rate's going to increase by refinancing, it's a better situation for you as the borrower. So the lenders can potentially get more market share by getting these refinances, and the borrowers like ourselves can get a better deal. So I see this as a win-win situation. Now, the thing is, this does not apply to new loans. APRA, which is the Australian Prudential Regulatory Authority, does require the banks to use that 3% buffer on new loans. But because these existing loans are being transferred dollar for dollar, that's why the banks can use this 1% buffer rather than the 3% buffer for these loans. The other interesting thing here is APRA estimates around 880,000 fixed-term mortgages will finish in 2023. So what that means is that 880,000 people will go from fixed rates to variable rates and go from potentially 2 to 3% to 5 or 6 or 7%. And that's where these banks are looking to get this business. As these people come off these fixed rate mortgages onto variable loans, they might want to look to refinance to get a better deal. So using these lower thresholds is better for those Aussies. So where we stand today is both CBA and Westpac are offering these refinance deals, and it's likely that the other big banks will follow to try and compete and keep up. So as I promised at the start of the video, what are Emily and I doing? Like I said, I've talked about our refinance for the unit block, but how do we manage our entire property portfolio to be both tax efficient and profitable and run things as best we can based on the numbers that we've got in front of us? So what I like to do is I look at my owner-occupied debt and my investment debt. And for round numbers, say I've got $500,000 of owner-occupied debt and $2 million of investment debt. What this means is we got $2.5 million of debt on a $5 million property portfolio. The way I like to do it is I want to park as much cash in my offset account against the $500,000 of owner-occupier debt. The reason is the owner-occupier debt is non-deductible for tax purposes, so I can't claim interest deductions in my tax return for my principal place of residence. Whereas, say the $2 million of investment debt, say we've got $1 million for the unit block, which we're refinancing over to CBA, and another $1 million of investment debt, those loans split up between each of my properties are deductible for tax purposes. So we've got our owner-occupied residence with a 100% offset account and our investment loans separate, with each property having a separate loan. The reason we want to keep our investment properties separate is we don't want to cross-collateralize the loan. So I don't want just one loan for $2 million. I want a $500,000 loan, a $500,000 loan, and a $1 million loan with each of my investment properties. This means if I decide to move one of my properties away from CBA, for example, that I have the ability to do that and my properties aren't tied in together. It also allows me to get more favorable valuations. So if I want to go to multiple banks to get multiple valuations and potentially look at refinancing, I have more control in that scenario. So this is exactly what Emily and I are doing. We're refinancing our unit block over to CBA and getting around a 6.5% interest rate for our investment property in Coffs Harbour. Now, I will be breaking down a video in the future around all our interest rates. We still have some fixed interest rates out towards December 2023. So we're very lucky in that regard because those rates are sitting sub 3% at this point in time. We also have a raise and build project, which we're very excited to be starting in the next few months. And I'll keep you guys up to date as to what's happening with interest rates in Australia's market. So whether you're an owner occupier or an investor, you can set yourself up and get a great deal. Now, if you're interested in taking your investing knowledge to the next level, head over to purposeproperty.com.au and you can buy a copy of my course, Invest with Purpose, for less than $500. It is the end-to-end of real estate investing, and I break down all my knowledge when it comes to real estate in that course, which is less than $500. If you're interested in seeing how you can make millions of dollars buying boring real estate, then make sure you click this video over here. I'll see you in the next one. Peace.